Welcome to Ito Analytics, the leading platform for providing volatility data and option analytics. This is Chapter 11 of Option Trading Tutorial Series. We will continue our real-life case study in this chapter. The example we are looking at in this chapter is Shopify, and we are looking at earnings event betting. As of 7th of February 2025, Shopify was at $117.41. From daily and weekly options trading in the market, we can back out the implied daily move from at-the-money implied volatility on those options. When we look at the implied daily move on Shopify, we can see that option market is implying 13% move on earnings date. Based on this information, traders can bet on the earnings move with options. If traders expect Shopify to move more than 13%, either up or down, on earnings date, traders can buy in 1 week at the money straddle and sell the straddle after the earnings release. The idea is to capture the earnings movement by taking a long position on straddle. If Shopify really moves more than 13%, the gain in intrinsic value on straddle should be more than the loss in straddle value due to volatility drop. On the opposite side, if traders expect Shopify to move less than 13% on earnings date, traders can sell in 1 week straddle and buy back after earnings. The idea is to short the earnings implied move implied in the market. If Shopify moves less than 13% on earnings date, the decay in straddle value due to implied volatility drop should be more than the gain in intrinsic value due to movement. We can use our option pricer to price in 117 strike straddle, which is the closest to at-the-money strike straddle available in listed market. The straddle costs around 13.5% premium. If Shopify goes up 20% to $140.89, with implied volatility drops to 40% after earnings release, the 1 week straddle will then cost 17%. This is around 3.5% higher than the initial premium. If traders bought the straddle to bet on Shopify moving more than 13%, traders can then profit from this long straddle position. On the other hand, if Shopify goes up only 5% to $123.28 after earnings release, with implied volatility drops to 40%, then the straddle price will drop to 6.2%. If traders sold in 1 week straddle to bet Shopify moving less than 13%, then the traders will make a profit of 7.3% as straddle premium drops from 13.5% to 6.2%. Instead of straddle, strangle is another way to bet on earnings movement. Strangle is considered to have lower risks compared to straddle. For example, traders can choose to buy or sell 135 and 100 and 2 strike 1 week strangle, which are roughly 13% out of the money call and put. Premium of this strangle is roughly 4%. If Shopify moves less than 13%, strangle sellers can basically pocket 4% premium. If Shopify moves more than 13%, strangle buyers can make some profit from the gain in intrinsic value on one of the legs in strangle. Other than purely betting on underlying movement on earnings date, option traders can also consider a directional play by trading out of the money call or put. If traders are bullish on Shopify, traders can consider selling in 1 week 100 and 2 strike put, which is roughly 13% out of the money put. Or traders can consider selling in 1 week 100 and 35 strike call if traders already holding some Shopify stocks and planning to do a covered call. Idea is to sell a 13% out of the money call to take advantage of the inflated short-term volatility ahead of earnings. These 13% out of the money call and put costs around 2% premium. Making 2% premium through selling option in 1 week is considered as very profitable, as risk-free rate is only at 4% at the time. As summary, we talked about option implied daily move in this chapter. Implied daily move is particularly useful to estimate the movements in key events such as company earnings release. Traders can bet on this earnings movement by buying or selling straddles and strangles. On the other hand, understanding market implied movement also allows traders to formulate directional play strategies by trading out of the money calls or puts. This is the end of Chapter 11. Visit Ito Analytics website to get access to volatility data and option analytics covered in this chapter.